Today, tight credit markets hit banking's big beasts. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problems with a distinctively Australian flavour. Well, the Dow ended well above session lows on Thursday as Federal Reserve officials wrestled back control of the rate hike narrative, cooling bets on a 1% rate hike, after Wall Street's banks kicked off the quarterly earnings season with gloomy results. The Dow Jones Industrial Average fell 0.5%. The Nasdaq was up 0.03% and the S&P 500 fell 0.3%. All three major averages were down more than 2% at the lows of the session. Technology stocks led the move off the lows for the broader market as Treasury yields retreated after Federal Governor Christopher Waller played down the prospect of the central bank rolling out an unprecedented 1% rate hike later this month. You don't want to overdo rate hikes, Waller said on Thursday, adding that the market had got ahead of themselves on pricing a 100 basis point rate hike, although he didn't rule out the prospect of a larger hike. If that data came in materially stronger than expected, it would make me lean towards a larger hike at the July meeting, he added. And St. Louis Federal Reserve President James Bullard reportedly also said he would favour a 75 basis point hike at the July meeting. But the odds of a 1% rate hike fell to about 44% from the 80% a day earlier. But the big banks were in the spotlight on results updates. JPMorgan said it would temporarily pause share buybacks after reporting second quarter earnings that fell short of estimates, sending its shares more than 3% lower. And it also set aside more money than expected for potential loan losses, raising concerns about the strength of the US consumer. And Morgan Stanley also reported a miss on second quarter earnings, driven by weaker performance in its investment banking business. Its shares recovered to trade flat after falling more than 2%. And Wells Fargo and Citigroup, which both report on Friday, were down nearly 1% and 3% respectively. But it is worth looking at what those bankers said in more detail. JPMorgan Chase temporarily suspended share buybacks and reported second quarter results that fell short of analyst estimates, driving the stock as much as 5.1% lower at one stage. The buyback pause is needed to quickly meet higher capital requirements and to allow us maximum flexibility to best serve our customers, clients and community through a broad range of economic environments, the Chief Executive Officer Jamie Dimon said in a statement. The results offer the first look at how Wall Street fared in a tumultuous 3 months, characterized by changing outlooks on prospects for the economy. And Morgan Stanley also missed estimates as revenue from investment banking slumped to 55%. Dimon warned of an economic hurricane last month, citing the challenges the Federal Reserve faces as it tries to rein in inflation. They added $428 million to the pile of money it set aside for potential sour loans, reflecting a modest deterioration in the economic outlook. That marks a reversal from last year, when the firm's results were padded by $3 billion of reserves released. While the US economy continues to grow, with consumer spending and the jobs market both healthy, geopolitical tensions, high inflation, uncertainty over rate hikes, and the impact of Russia's invasion of Ukraine are very likely to have negative consequences on the global economy sometime down the road, Dimon said. We are prepared for whatever happens and will continue to serve clients even in the toughest of times. Investment banking fees declined 54%. That's more than the 47% drop that analysts predicted, as dramatic market moves in the quarter stymied deal-making. That division was also hurt by $257 million of markdowns on held-for-sale positions in the bank's so-called bridge book, according to the earnings statement. June was a particularly slow month for the capital markets business. The Chief Financial Officer, Jeremy Burnham, said on a conference call with journalists, trading revenue jumped 15% to $7.8 billion, the New York-based company said, while analysts had expected it to be 70% higher. Trading markets whipsawed with each release of economic data during the quarter as investors evaluated the Federal Reserve's ability to contain inflation with interest rate hikes. wrote President Daniel Pinto in the note to employees. Though results fell short of expectations, strength in currencies, emerging markets and equities drove the firm's second best quarter ever for trading. And JPMorgan said regulators will require its common equity Tier 1 ratio to be 12.5% by the first quarter of next year due to a harsher stress test result and a previously flagged increase in its buffer for systemic importance. That's up from a minimum of 11.2% at the end of June and significantly higher than the 11.7% requirement that the firm told investors just 2 months ago to expect for early 2023. The buyback pause should allow the bank to get to 13.2% by next March, comfortably clearing regulators' bars. But that comes at the cost of handing back money to investors. So JPMorgan had averaged about $2.2 billion of buybacks a quarter over the past year, on top of $3 billion a quarter of dividend payments. The firm's net income fell 28% to $8.6 billion or $2.76 a share, and analysts were predicting $8.9 billion. And JPMorgan's non-interest expenses rose 6% to $18.7 billion, lower than analysts were expecting. The firm's costs have been a focal point for investors after executives said they expected an 8.6% increase this year. Net interest income, a key source of revenue for JPMorgan, rose 19% in the second quarter on higher interest rates and loan growth, and analysts had expected a 16% increase. And the company said it expects net interest income of $58 billion this year, the third such increase this year, and higher than the $56 billion it projected in May. And Morgan Stanley's revenue from investment banking plummeted as capital markets seized up, underlining a slow quarter for Wall Street as a dour outlook for the economy muddies the path forward. The firm's investment banking group posted $1.07 billion in revenue. That's down 55% from a year earlier, a bigger decline than the 47% drop analysts had predicted. The bank also reported an additional $413 million hit, driven by mark-to-market losses on corporate loans held for sale as credit spreads widened. Morgan Stanley's trading unit helped pick up the slack as fixed income revenue surged amid heightened volatility and clients scrambled to reposition their books. Surging inflation and Federal Reserve efforts to help combat it have put investors on watch for a recession and the spillover effect an economic contraction can have for financial firms. Banks' capital markets units, which have lifted fortunes across the industry over the past 2 years, were hurt by a sharp slowdown in the second quarter. It was a very solid quarter in the face of market volatility, Chief Financial Officer Sharon Yeshesha said in an interview. Market activity and client activity should help support the level in equities and fixed income businesses, but the volatility delays in some of the pipeline to convert on the investment banking side, especially on the M&A side. Morgan Stanley shares slumped 23% in the first 6 months of the year. That's its worst performance for 2 consecutive quarters in more than a decade. Trading revenue of $5.46 billion surpassed the $5.1 billion average estimate, and it was up from $4.51 billion a year ago. That was mostly led by a 49% jump in fixed income revenue, which climbed to $2.5 billion. Strong results in equity and fixed income helped partially counter weaker investment banking activity, the CEO said in a statement. Revenue from equity underwriting plunged to $148 million, while debt underwriting declined 49% to $326 million, and advisory revenue fell 9.9% to $598 million. Last week, Morgan Stanley picked 2 veteran deal makers as the new head of its investment banking group, Eli Gross, who led the transportation infrastructure banking practice, and Simon Smith, who helmed the European banking franchise, have both been at the bank since 1998. On the outlook for mergers and acquisitions, the speed in the market movement and the speed in price discovery has caused people to stop. They said it's unclear if sellers have yet digested those prices. The New York-based firm was also first to lend credibility to Elon Musk's attempt in April to buy Twitter by helping cobble together the financing for the $44 billion bid. Since then, it's also been dragged into the ensuing mess after the world's richest man changed his mind about wanting to buy the social media platform. Wealth management, where Morgan Stanley is anticipating higher net interest income this year as a result of rising rates, reported a revenue of $5.74 billion in the second quarter. That's down 5.9% from a year earlier. and net new assets fell 26% to $52.9 billion. The bank posted net inflows despite having double than average tax outflows this year. And firm-wide, Morgan Stanley expects $500 million of extra net interest income in the next 2 quarters, they said. And the company also disclosed on Thursday that it expects to pay a $200 million fine relating to a specific regulatory matter concerning the use of unapproved personal devices and the firm's record-keeping requirements. Regulators have been probing the matter across Wall Street. Morgan Stanley's total non-interest expenses totaled $9.71 billion. That's higher than the $9.53 billion that analysts were expecting. But effectively, both Jamie Dimon and James Gorman both said that they aren't steering their firms towards shelter, even as they see a confluence of global events denting the economy in the months ahead. The consumer right now is in great shape, Dimon said in the conference call discussing his company's second quarter results. So even if we go into a recession, they're entering that recession with less leverage and in far better shape than they did in 2008 or 9. Gorman on his bank's earnings call said a deep or dramatic recession in the US was unlikely, and Morgan Stanley is long the US in most of its businesses. The US is a great region to be in the world, but risks abound, with soaring inflation spurring central banks around the world to dial back their easy money policies that had pushed markets to all-time highs. Russia's invasion of Ukraine, along with worries about food and energy security, as well as political instability across regions, are also keeping investors on edge. If I had to use one word to describe it, it would be complicated, Gorman said, on the challenges facing the global economy. And he said that Europe is fighting the hardest with the dual threat of the war in Ukraine and pressures on gas prices that's been particularly problematic for countries such as Germany. Dimon, meanwhile, said his previous forecast of a looming economic hurricane hadn't actually changed, but that the health of the American consumer offers a positive break in the clouds. Both Dimon and his chief financial officer, Jeremy Barnum, emphasized the strength of the US job market and consumer spending as indicative of JPMorgan's future growth, even amid rampant fears of recession. And they pointed to robust credit card loan growth and continued strength in discretionary spending, even with a 35% increase in outlays for consumer staples such as gasoline. We've looked a lot, very carefully, at our actual data, they said. There's essentially no evidence of any weakness, citing very strong credit performance despite broader questions around interest rate hikes. Investment banking operations at both firms, the first of the US financial giants to report second quarter results, were hurt by a sharp slowdown. A decline even more dramatic than predicted by analysts. Investment banking fees plunged 54% at JPMorgan and 55% at Morgan Stanley as capital markets seized up. Even as executives talked up their bank's ability to face down a recession, they've also prepared for a downturn that could prove deeper than their expectations. Morgan Stanley said that the firm is performing a close scrub of expenses. Still, there's no rush to completely switch strategies, Gorman said. We have a lot of stuff going on, and we have choices as to when we do it. It's sort of plan A minus not a plan B, if you will. That's a mindset we are in, he said. However, if things get worse, and in my career I've seen a lot of recessions, a lot of crises, a lot of damage done in the environment, if things really deteriorated, particularly in the US, then we'd take a much more aggressive position. But the quarterly bank bond boom is set to be a tamer affair this earnings season, with costs rising and the market's biggest borrowers already ahead of their financing schedules. Issuance will underwhelm post-earnings results, JPMorgan analysts wrote in a note. The analysts forecast that the biggest banks will sell between $14 billion and $16 billion worth of bonds this month. That's well below the $19 billion that makes July the fourth highest month for debt sales from Wall Street stalwarts. Bank bond sales in both May and June trailed historic averages at a time when spreads were tighter, possibly indicating limited supply needs, wrote the analysts. And spreads continue to widen following Thursday's earnings reports, increasing costs for prospective borrowers. JPMorgan's 4.586% bond maturing in 2033 widened 6 basis points to 188, and meanwhile Morgan Stanley's 5.297% bonds due 2037 widened 8 basis points to 280 basis points. The average spread on a financial institution bond was at 1.56% as of Wednesday, after widening to the highest level since June 2020 at the start of the month. Spreads on the broader high-grade bond index are lower at 1.51% as the Federal Reserve raises interest rates to try to tame the fastest inflation since the 1980s. Spread, not yield, matters for banks, the JPMorgan report said. They have tended to be more opportunistic than programmatic this year. Financial companies front-loaded their borrowing needs as the Fed shifted monetary policy to tighten liquidity and raise overnight lending rates 3 times already this year, with more increases on the horizon. The finance sector has sold more than $394 billion worth of bonds in 2022. That represents about 52% of investment-grade volume. The biggest US banks traditionally issue bonds soon after reporting their results, particularly if the yield curve presents an opportunity for lowered borrowing costs. A spike in yields over the past 3 months makes this less likely. It's hard to bet against these banks coming to the debt market after earnings, but they've got a lot of what they've wanted to do already. So that will help bring down the pace of issuance for the second half. Citigroup may be finished with bond sales for the year, considering the lender raised $20 billion in the first half, reaching the high end of its annual supply, they said. And JPMorgan may slow its pace of offerings in the second half, they said. To be sure, some of the big banks likely will sell debt soon after earnings. Morgan Stanley and Bank of America, who raised $8.5 billion and $7.75 billion respectively after reporting earnings in July 21, have room to bring new deals this month, the analyst said. And Goldman Sachs, which borrowed $5.5 billion this time last year, may also sell bonds, they added. And they anticipate Wells Fargo may be active in the second half as it has the most extra capital and the capacity to do share buybacks. And the size and schedule of bank borrowing may depend on what the lenders have to say about their profitability. While the Fed's rate hikes are expected to prove a boost for net interest income, a key source of revenue for the big banks, the 2 earnings reports on Thursday shows the challenges that banks face amid volatile markets and a slowing economy. A $27.8 billion haul in trading revenue, according to analyst estimates compiled by Bloomberg, should help earnings, countering a hit from slowdowns in investment banking and mortgage businesses and a drop in valuations at their wealth management arms. An investor demand to take on more debt will help determine banks' capital raising plans. Investors have yanked cash from the US high-grade bond market funds for 15 straight weeks, extending the longest losing streak on record. And bonds also suffered their worst first half on record, underperforming every other major category of debt in the US. But I want to stress this point, that the cost of funding the banks is rising, and rising quite fast. It's linked to the current bond rate. And that means that effectively banks will be under margin pressure as they try and navigate the next few months. Because if you think back, banks were able to raise funds at very, very cheap rates, and while the net interest margins were under pressure, that won't necessarily change. And here in Australia, I'd also add that banks will be looking to tap the international financial markets probably more rather than less ahead, and that's going to put extra pressure on them too. So this is going to be a very interesting and important time. I do expect pressures on the banks to maintain significant momentum simply because they have to try and make a significant return in the difficult environment. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.